Hello and welcome. In this session, we're going to talking about the cash flow statement. This is one of the paper from the ACCA, and we called it financial reporting. And the cash flow is one of the important topic we have in F7 or the paper we call financial reporting. The reason cash flow is important because every exam we're going to see some question from the cash flow statement. And not only from the exam point of view, the cash flow statement is very important also from the understanding point of view, how the financial statement is different when you prepare the cash flow statement. Now, so far from our previous studies, we have learned how to prepare the uh, statement of financial position for a company, for a limited company. And so far, we know we have a 5 part of the limited company account. So we have a profit and loss account, we have a statement of changes in equity, we have a balance sheet, and we have a notes to the account. And the final one and the last one, we called it cash flow statement. So the cash flow statement is one of the important part of the annual accounts. So even though normally when you talk about annual accounts, we talk about only the profit and loss account and the statement of financial position, but cash flow is one of the important part. Now, before we start the cash flow statement, let's talk a little bit about the cash flow statement. Why cash flow statement is very important. The first thing I like to mention, when you prepare the accounts, when you prepare the limited company accounts, we use accrual concept. Now, so far we know accrual concept means we match the transaction rather than when we receive or we actually pay to the supplier, but when the transaction is occurred or when this has happened. So for example, if the transaction happened before the end of the year, and if the customer paid us next year or next month, even after the year end, we still need to consider the transaction based on the accrual concept. And for that reason, when you prepare our profit and loss account and the balance sheet, sometimes the some transaction could be subjective. Now, when I say subjective, what does that mean? That means it is possible the transaction is not reflected with the cash. For example, if we make a credit sale and our profit will be very much in the profit and loss account. For example, you make a lot of sales and the business have a lot of profit, but actually when you open the bank account, we see there is no cash because most of the customer is a credit customer. And if the credit customer don't pay on time, or if they take long time to make the payment, or there's a lot of irrecoverable debt, it is possible the profit and loss account and the cash flow have a huge difference because on the paper, on the profit and loss account, there's a lot of money showing the business have, and actually on the bank, maybe the business is suffering of working capital and there are shortage of the cash flow. It's very important because to run a business, every business need the working capital, and the working capital is the combination of three things. Normally, when you calculate the working capital, we are looking at the inventory, we are looking at the trade receivables, and we are looking at the trade payable. What does that mean? That means how quickly we can sell our closing stock, the inventory. So more quickly we can sell, it is good for us. And also how quickly we can collect the money from our credit customer. That means how good we are to collect the money from the credit customer or from the trade receivables, or how good our credit control in order to collect the debt. And finally, how long we take to pay to our supplier. So ideally, we should able to sell the inventory quickly. Ideally, the money we should collect from our credit customer quickly, then the money we pay to our supplier. So this is basically the changes for the working capital. On the other hand, as a stakeholder or the prospective investor, before they invest the money to the company, they like to see the working capital situation for the business. For example, let's say if you like to invest some money on Tesco, so you're not only looking at their profit and loss account and the balance sheet because that is a subjective figure. So the figure you see on the profit and loss account is a prepared based on the accrual concept. That means the profit you can see maybe 1 million, but actually on the bank is not the same amount. For that reason, addition of the statement of profit and loss account and the balance sheet, we also like to see the cash flow statement. And for that reason, every single stakeholder, they prepare the cash flow statement. For the prospective investor, the company prepare the cash flow statement. And if you are a public limited company, by statutory or by law, you have to prepare the notes to the account and the cash flow statement. But if you are a private limited company, maybe it is up to the company choice. They can prepare the cash flow statement for their own reason, for their own purpose. If they don't want, there is no legal requirement for that. But sometimes the third parties, they might ask for the cash flow statement. For example, the lenders, for example, the bank. So bank can ask, I like to see additional cash flow statement before I can approve the loan. Or for example, any lease arrangement or the supplier credit term. Maybe they like to see how financially feasible you are before they approve the credit term or approve any loan or overdraft facility. For that reason, even though we have a profit and loss account on the balance sheet, top of that, it is important to understand how to prepare the cash flow statement. Let's have a look one of the template from here. And we are going to look at a few things from here. The first thing, we're going to look at how to prepare the cash flow statement. Then we're going to look at how to make a comment, because interpreting the cash flow is also important to understand. In the exam, they will ask you to calculate the cash flow, not only just to prepare the cash flow statement. At the same time, they'll ask you interpret or explain or give a recommendation or what you understand by looking at this cash flow statement. So you have to explain based on the three activities you're going to look at from this cash flow statement. Now, cash flow statement is covered under IAS 7, that is International Accounting Standard 7. So IAS 7 cover the cash flow statement. Cash flow statement can be prepared under two methods. One is the direct method and one is the indirect method. But for the exam, we have to learn the indirect method. Direct method normally are never tested in the exam. So the most commonly used method in the workplace, or if anyone asks you to prepare the cash flow statement, you can always prepare the indirect method, even though there is not much different, but we recommend to learn the format for the indirect method, because this is the one will be tested in the exam. All right, we have some theory, benefit of the cash flow statement. We're not going to go on that theory. We're going to look at how to prepare the cash flow statement. Now, the cash flow statement is the combination of three areas. So this is one we have to focus. So you have to learn about the three areas. The first one we have here, cash flow from operating activities. Now, this area is very important, and this is the big one. So here, what we do actually, so for example, when we have a normal profit and loss account, so for example, let's see if I say P&L account. So normally what we do, we have a sales, and from the sales, we minus the cost of sales. And then we have a gross profit. And from the gross profit, we minus all the overhead. For example, the rent and rates, bills, advertising. So all the overheads, we minus from here to find the PBIT, that is profit before interest and tax. So PBIT. And from the PBIT, the first thing we do, we take out the interest. So interest. And after that, we have a PBT, that is profit before tax. And from the PBT, we minus the tax. And then we have a profit after tax. We called it PAT, profit after and tax. And from this amount, profit after tax, we like to see how much dividend we like to pay to our shareholders. So it depends. The company can pay as much dividend as they want. They can distribute all the profit. So this is the normal profit and loss account we prepare under the accrual concept. Now, when you prepare the cash flow statement, we start from the profit before tax. Profit before tax. Now here, if the question give you interest, is fine. If the question don't give you the interest, we need to look at, is there interest relevant with this question. Now it is possible, remember that it is possible the interest for the whole year, for example, 10,000, but 5,000 is a payable at the end of the year. That means the 5 is already paid. For example, for the beginning of the year, interest was 10, and at the end of the year, now the interest remaining is 5. That means during the year, I paid 5. Now, in the cash flow statement, we are looking at cash inflow and cash outflow. That means how much cash actually I received, how much cash actually I paid from the business for any reason. Remember that it is not the ledger account that you have learned for the cash flow. For example, cash in the debit side, cash out in the credit side. It's not that. It's very simple. Like you need to see if there for any reason cash coming to the business, so you need to make it like increase the balance. If for any reason, if the cash go outside from the business, you need to minus it. Simple calculation. Money in, add up. Money out, subtract, take away. But we need to follow one format. Now we start from the cash flow and we start from profit before interest on tax. Sometimes we can start from profit before tax. It depends we have the interest or not. So let's say, for example, we started from the profit before interest and tax, or we start with profit before tax, whatever it is. The first adjustment we do that for the non-cash item. Now, when I said the non-cash item, what does that mean? Non-cash item represent the item, the entity that is recorded in the profit and loss account, but because of this entry, there is no actual cash movement from the business. For example, I'm showing some expense, but because of this expense, I never paid any cash. For example, depreciation. The depreciation just on the paper, but because of the depreciation, we actually never paid any money. For example, when you have a non-current asset, what we do the depreciation. And obviously this depreciation just on the paper, because we believe this non-current asset, one day the useful life need to be end. And that time we need to replace that asset. For that reason, we recorded the depreciation as an expense on the profit and loss account. At the same time, we recorded as accumulated depreciation on the balance sheet that reduce the value of the non-current asset to find the carrying value. And that's how we carry on. And we have set up like how many years the useful life will be for the asset. And after that period, the asset need to be replaced. For that reason, we recorded the depreciation for a tangible asset. And same thing we do for the intangible asset. For example, the development cost, or for example, any asset lease. On that case, we don't use the word depreciation, but we called it amortization. But the story is same, the way we calculate is same. So either it is depreciation or amortization. For the cash flow point of view, the recording structure is same. So we just call, if it is a tangible asset, we call it depreciation. If it is intangible asset, we called it amortization. So just need to remember that. So any non-cash item we need to add back. Why is that? For example, when you calculate the profit after tax, and on the overhead, we minus the depreciation. We minus the depreciation, we minus the amortization, and because of that, my profit is going down. So let's see if I show the depreciation is £10 and amortization is £10. That means £20 I show as expense. So my profit is down by £20. But actually, because of this expense, I never paid any money from the business. So no actual cash going out from my bank. For that reason, this 20 I need to add back. So what I'm trying to explain here, if any non-cash item that is basically not paid any money because of this transaction, I need to add back. So depreciation or the amortization, I'm going to add back. Now we're going to discuss all this thing on the operating activities. Now, before we go in detail, let me explain a little bit the difference between these three. So we are following three activities: the operating activities, the investing activities, and the financing activities. Operating activities is all linked with the trading activities. Trading activities means day-to-day business. For example, how much I'm selling, how much money should come. So it's my trading, like how much is the sales, how much is the overhead, how much is the expense. So it's all about my operating activities. And with the operating activities, after that, we have to we have to do one thing. What we need to do, we need to so as we have discussed, so obviously, like the first thing we need to focus on the operating activities. Now, operating activities, of course, as I said, it is linked with the day-to-day activities for the business. So basically, what happened if the business have some more. So if the business have running cost, for example, the overhead or any other thing, that will be under the operating activities. Now, of course, like operating activities is the first one we need to focus for the cash flow statement. In operating activities, we are looking at the interest paid, the tax paid, and also going to look at the working capital changes. So when you're going to start one of the example, we're going to do it in detail, but for the time being, let's understand what is working capital changes. Working capital is the combination of three things. We need to look at the trade receivables, we need to look at the trade payable, and also the inventories. So this one we need to see if it's increase or decrease. All we're going to look at, are because of this transaction, is there any money into the business? If it is in, is inflow. If it is out, it is outflow. So you are looking at from the whole cash flow statement, is it money inflow or outflow? The next thing we're going to look at under the operating activities is any profit on disposal of the non-current asset. Remember that selling the non-current asset is not the main purpose of the business. That means, for example, if we have a business to sell the pen, so we cannot just sell the computer. For example, the business have some computer, but their main purpose is to sell the pen. So what will happen if this business decide to sell some non-current asset? For example, if they sell some van or some computer and they make some profit, but this is not part of their operating activities. Remember that this is not part of their operating activities. For that reason, we have to take it out. So we need to minus this one. We cannot record it, the profit on disposal. Normally, when you have a profit, we record it on the P&L account. So when you prepare the cash flow statement, we need to take it out from here because this is part of the investing activities. So this thing is important to remember. So the whole template has to be on our head. The next thing, we're going to look at the tax paid. Now we need to do a little bit working for that. For example, in the question, they will give us the tax from the previous year, the tax from the current year, and how much is the tax during the year. So we don't mind how much the tax or how much we need to pay. We are looking at how much is paid during the year. Now, the reason we have to do some workings, because for this year tax, normally we paid next year. So normally the company have accounting period. For example, the accounting period for 2024 is January to December. That means any calculation we'll do after December, for example, Jan to December is 1 year. So for after the December, I will still have 9 months to calculate the tax, and I will pay the tax on next year. For example, for the year 2023, I'm going to pay the tax on 2024. For that reason, we need the manual calculation. We need the adjustment, and we're going to see how to work for that. So we have two types of tax. Remember that we have a corporation tax and we also have a deferred tax. Both need to be considered. Sometimes the student, they only do the workings for the corporation tax and they do not consider the deferred tax, and this is not the right way. We're going to look at all of that. The final thing we need to looking at for the operating activities is the interest payment. As we discussed before, interest is basically the additional expense for the business. It is not necessary every business have to have the interest expense. For example, if the business don't have any loan, so they don't have any interest. So only the business could have interest if they have some loan. For that reason, interest need to be first added back. So how much is the interest during the year? We need to add back, and later on we need to look at how much interest we paid during the year. So we need to minus that. Very careful. If all the interest is paid, then we need to minus the full amount. But if half of the interest is remaining, we only minus the half. We're going to look at all of this thing in detail anyway. All right, the next one we have here, that is investing activities. Investing activities is all about how much money business spended to buy the PPE, that is property, plant, and equipment, PPE. So PPE is, for example, could be the equipment, could be the machinery, could be any asset like property. So it will become under together PPE. So we want to see how much asset we had at the beginning of the year and how much we have during the year. For example, let's say 2023, we have an asset, for example, £100. And 2024, we have a asset for £200. That means we buy £100 new assets. We had 200 before. Now we had 100 before. Now we have 200. That means £100 is added. And that means 100 I paid. So 100 is outflow. So if there is a purchase of PPE is outflow of the cash. If we sold something PPE, that will be the inflow. But few things still need to consider. For example, is there any movement of the PPE during the year? For example, if we sold some asset, for example, we have 100, but we also sold during the year a 50. So we should have 50, but we have 200. That means 150 will be added, not 100. So we need to see how much was the beginning of the year, then how much is the depreciation, how much is the disposal, then how much I should have, but how much I actually have. The difference will tell me how much I paid during the year for the PPE. Here with the investing activities, it's very simple. Investing activities is all about the purchase of PPE, the disposal of PPE, and also the investment. So very important. This three is the main topic for our investing activities. Also, we need to remember the dividend. Remember that we can receive the dividend and we can pay the dividend. We only pay the dividend if someone invests. So if someone invests on us, then we can pay the dividend. And we receive the dividend basically if we invest. So the dividend could be on the investing activities and the dividend could be on the financing activities and both. So you need to be careful. Are we receiving the dividend? Are we paying the dividend? So if someone invests on our company, so dividend will be paid. If we invest to someone company, then dividend will be received. So finally, you have a financing activities. Financing activities quite straightforward. We're looking at share capital, share premium. So is there any new share issue during the year? How much we get the loan? For example, at the last year, my loan was 100, but this year the loan is 200. That means I took another £100 loan that will be cash inflow. So we need to looking at that like in detail. Then we're looking at the loan notes, any repayment of the borrowed money, dividend paid to the shareholder. So any less liability, for example, repayment of the capital, we need to looking at that for any reason. For example, let's say my bank loan was last year 100 and this year the bank loan is 50. That means I paid 50, so it's outflow. If there is a share issue, if there is a share premium, we're going to consider all of these things here. So we have three activities. Operating activities, investing activities, and the financing activities. So operating activities is linked with the business day-to-day the trading activities, and operating activities mainly we're going to prepare by looking at the profit and loss account and additional information. But on the other hand, investing activities will be mainly with the balance sheet and the additional information. The financing activities also linked with the balance sheet, but the operating activities is mainly linked with the profit on loss account, except the working capital changes for the inventory, for the trade receivables, and for the payables. All right, so let's have a look one of the template now. So we are looking at one template, how to prepare. So we have indirect method. So you can see here. So start with the cash flow from operating activities. So let's look at this one. So we're going to quickly look that. Then I'm going to explain in detail. Then we're going to do one question together to understand it better way. So indirect method, pro forma. This is an example of completed statement of cash flow which has been prepared using the indirect method. It will be in the exam indirect method. Don't worry about the direct method at all. So cash flow from operating activities. So we start with this one, profit before taxation. So profit before tax, if the question have interest, remember that we need to add back the interest. If the question don't have an interest, we don't have to worry about that, but you're going to see the interest in the exam anyway. So that will be our first point, profit before tax. And we're going to look at this information from our profit and loss account. In the exam, they will give us the full financial statement. So they will give us the profit and loss account and the balance sheet and the additional information. So you can pick what information we need. So start with the profit before taxation, then we do adjustment for the depreciation. So depreciation, if you anything you see without bracket is a positive, is a plus, and if it is a bracket, that means it is a negative. So we have here depreciation and amortization, both are same story. Depreciation is for the tangible asset, and amortization for the non-tangible asset or intangible asset. We just added back because it's a non-cash item. Then you're looking at here profit on sale of property, plant, equipment. So if I sold any non-current asset, could be PPE, could be anything. Remember that we need to minus it if we make a profit. But if we make a loss, we need to add back. So this is not my business to sell the non-current asset. For that reason, I'm not going to consider this one here. But you might thinking like, oh, if I sell something, if I make a profit, then money should be in the business. Why are you not considering? You are right. We're going to consider that, but not in the operating activities, on the investing activities. It's not the right place for them. So you need to follow the template. So profit on sale of the property, plant, equipment. So this is minus because we need to take out from here and record somewhere else on the investing activities. Then we have an investment income. If we have, again, investment income is non-current calculation. If I have investment income, I need to take it out. And the interest expense will be quite interesting because we're going to add back and later on we're going to pay it. So for example, look at the interest expense here, and again we have an interest paid here. So 400, actually the interest expense we add back. So we added back, and later on how much we paid, we minus that. Now it is possible if we have an interest like 400, it is possible I didn't pay all the interest during the year. Some interest could be is still my liability to pay. For that reason, I don't have to show in the cash flow statement, because cash flow statement only focus how much cash actually paid, how much cash actually received. So I really don't have to look at if anything is outstanding. So my interest expense was 400, but actually I paid 270. So I only consider 270 is gone, 400 added back. But of course, like when you prepare the profit and loss account, we take all 400 because we want to claim all the expense. But with the cash flow statement, we're only looking at how much actually paid from the business. Then we have a working capital changes. This is very important. Working capital changes. Working capital changes represent three things: inventory, trade receivables, and payable. Now, these three we're going to find it from our SOFP or from the balance sheet. And we're looking at is increase or decrease. We have to be very careful. Now, if it is a decrease, that means money in. For example, 2024 and 2023. Let's say 2023, the inventory was 200 and 2024 is 100. Is a decrease from last year to this year, is a decrease by 100. If it is decrease, what does that mean? I sold the inventory because my inventory going down. Is going down in stock means I sold it, and if I sold it, money in. For that reason, we have to add money in, decrease in. Same thing for the trade receivables, decrease money in because customer paid to me. That's why their balance is going down. So money going down. So if their balance going down, they paid to me. That's why. So again, trade receivables, and the trade payable is opposite. Trade payable, if it is a decrease, that means I paid more to them, so outflow. We will going to look at real example. For the time being, we need to understand if inventory is a decrease, trade receivable decrease is good for me because money in. We are not saying good for me, but because it could be different reason, but we are saying it's cash inflow. And the payable, if it is decreased outflow because I paid to my supplier, that's why balance going down. Need to be very careful with that. Then we do our next thing. The next thing we'll do for our calculation for the income tax paid. Here we need to do some workings. As I said before, the workings will be how much tax was the opening tax, how much is during the year, how much is the closing tax. I'll show you the workings, how to do it. It's not very difficult. We need to look at it. So that will tell us net cash flow from operating activities. The next one is cash flow from investing activities. As we discussed, very simple: purchase of PPE, purchase of intangible asset, and then proceed. Proceed means disposal or sale of PPE or equipment. If I sell, money in. If I purchase, money out, money going. And after that, interest received. If I receive any interest, then it will be here because of the investment. Remember that it's not the interest paid on the operating activities, interest received. Because I have some investment. Sometimes you have some money on the savings account on your business, you receive some interest. So this is kind of the interest we're talking here. Dividend received, again, I make some investment. If it's dividend paid, it will be financing activities. So this format has to be on our head. We have to remember it. We need to write it down in the paper a few times so that this format I can see as a picture. Then cash flow from financing activities. Here, looking at mainly the share capital and the return earnings. So proceed of share capital, proceed of long-term borrowing, payment of lease. So if I make a payment is minus, proceed means disposal. Remember that I issue some new share capital, I take some more loans, so money in. And payment means money going. Dividend paid, again, if someone invests on my company, I have to pay the dividend, so it will go down. And after that, these three, the operating activities, the investing activities, and the financing activities, we need to add these three to find the closing balance. So 1380, then minus 480, minus 790, and that gives me the net cash and cash equivalent. So we need to say net increase cash and cash equivalent. If it is minus, you called it net decrease, not increase. If it is minus, you called it decrease. But 110 is a plus figure, that's why it was increase. Then after that, we're looking at how much cash we have beginning of the year. So open our balance sheet, we're looking at how much is the cash and cash equivalent on the bank section. We added these two. And if we added this, that will give me the closing. And this one will be the closing balance on the balance sheet. This is the opening on the balance sheet. And we're going to look at exactly how it works. We're going to do a real example so we will understand better way. But at the end of the day, the cash book actually match with the balance sheet and we'll understand we done it correctly. So if it is match, we know we're getting the full marks. This is the template that we have to remember for our cash flow statement. So on the next section, I'm going to show you one question. We're going to do all the workings together. I'm going to explain in detail so that you understand in better ways. In the next section, we're going to talk in detail. We practice one question. Also after that, we're going to look at explanation, the interpretation of the cash flow statement.